don't stop looking for deals just because you don't have the money. And don't stop looking for money just because you don't have the deals. They are not related. They can be worked out individually. So always keep looking for money, right? And always keep looking for deals. Because what happens is people who can't raise the money are like, oh my God, I can't raise the money, so I'm not going to look for the deal. And people who can't find the deal stop raising the money. Oh my God, I don't have a deal, so I'm not going to raise the money.
Welcome to the Bulletproof Cashflow podcast. Let's get into the show.
Hey everyone, this is Agostino. There's a lot of talk about getting into real estate. One of the key elements of buying real estate is the underwriting and due diligence process. It is at this stage where you look for and hopefully uncover more value as you go through the materials or abandon the deal altogether. Well, today's guest understands this process very well. Prior to finding his own company, he decided to pick up and move halfway across the world, leaving Dubai and starting a business from scratch in Houston, Texas. From there, he started a company that currently has a portfolio of over 1,000 units in the Metro Houston area. He and his team use innovative strategies to maximize community management strategy as well as his investor returns. Today, as the founder of Gray Spear Capital, his group focuses on repositioning their assets to their full potential. With all that, I'd like to welcome Hamza Ali to the show. Hey, Hamza, thanks for coming on, man.
Hey, Agostino, appreciate it, man. Glad to be here.
Yeah, it's going to be awesome. Now, if you guys like what Hamza has to say, you can reach out to him via his contact page at grayspearcapital.com. And if you like our content, please don't forget to leave a comment and rate the show. Do that, helps us out tremendously. Finally, if you text the word freedom to 202-410-4202, you'll get our free ebook, The Bulletproof Guide to Finding a Broker. Okay, Hamza, go ahead and tell the listeners a little bit more about how you got your start in real estate.
Yeah, so for those of you who are interested in getting started in real estate, I have a very interesting story for you all. And Agostino, thanks for having me once again. I'd love to share, as much information as I can with the people, which is why I think these are great platforms. Anyway, so I actually moved from the Middle East about 6 years ago, end of 2013, beginning of 2014. I moved to the US. Not too much money in my pocket. I had a little bit of money. I had sold a small business. I think I had like a couple of $100,000 in my pocket at that point. And I had moved to an entirely new country, did not know what I was going to do, did not know how I was going to do it. And from Dubai, took a direct flight to Los Angeles. I thought, you know what? It's a beach city, LA. Dubai is a beach city. We have a lot of beachfront there. So similar activities, similar kind of people. And I was like, you know what? This sounds great. This is awesome. Let me go to LA and, I'm going to go and pursue my dream. And I landed in LA, went to a couple of meetups. At that time, we didn't have meetups. Meetups was not as popular as it is now. So you'd have to Google everything, like Google networking events, Google where people are meeting up, it was just a little more old school, I guess, than it is now. I think there was Facebook at that time. You could utilize Facebook to a certain degree to get together with a group of people who were interested in real estate. Anyways, ended up talking to a bunch of people, met a couple of brokers, quickly realized that my couple $100,000 really wasn't going to get me anywhere in Los Angeles. Ended up moving to Katy, Texas, which is a suburb of Houston. And the reason I moved there is I had an aunt who lived in Katy who was a school teacher. And she said, you know what, why don't you come here and take a look? There's a lot of construction. And at that time, that zip code was the fastest growing residential zip code in the entire US. Went there, bought a piece of land, developed the piece of land. I have a very interesting story on how I developed that piece of land, which we can get into a little later. Sold that, and then quickly realized that, you know what, multifamily is just crazy. Purchased my first 24 unit. And this is where I think today's topic, underwriting and due diligence, will come in, will help people, because I knew nothing about underwriting. I knew nothing about due diligence. I came from a country where basically there was no debt in place on any asset. So you just looked at it and you kind of bought it and hoped for, and crossed your fingers and hoped for the best, right? Really no due diligence whatsoever required back home. Anyways, did that, learned a lot, got stuck in that deal for 2 years, did not make any money on that 24 unit deal. And I'll get into that as to why I didn't make any money in that deal, which is why we need to do due diligence the way we do right now. Sold that deal, quickly realized that I don't need my money anymore. I can syndicate, and there's a lot of people who are interested in investing, and just took it from there and kind of, deal by deal, they got larger and larger. And today we're just under 1,000 doors, I think. So just under $1,000 in the Houston area for an immigrant who moved here 6 years ago, founded an entity. I think it's not bad. If I can do it, I think anybody can do it.
Excellent. Well, let's get into that deal. Let's tear it apart a little bit. So it sounds like you used your own money for that deal, right?
And so I did not. Well, a little bit, and yes and no. And I'll tell you why that is. I moved to the United States, walked into a bank and said, "Hey, I need leverage." And the banker looked at me and he's like, "What do you mean you need leverage? You need to give me more details." And I was like, "Yeah, I need leverage. I hear that there's a lot of leverage in this country and I need it." And they're like, "Okay, do you meet any of the qualifications?" And I'm like, "Qualifications? What are you talking about? I got a couple $100,000 and I'm going to buy a piece of land and I'm going to use it all. And and they're like, "No, it doesn't work that way." And I was like, "What do you mean?" And they're like, "You need 2 years of tax returns. You need to establish credit locally in the United States." And at that point, I had nothing. I didn't even have a credit card in the U.S. I had a beater car that I drove that I drove around. I put 80,000 miles on that car just looking for real estate deals in like 2 years.
Wow.
Yeah, that's how much driving. That's how much driving I did. Anyways, so I was like, okay, well, I don't have credit. I don't have a background. I don't have history. I don't have a social security number. It's like, what do I do? And so I went bank to bank, bank to bank. I found a really good banker who I do business with, by the way. I have a lot of debt in place with that bank today. They're a local Houston-based bank, and they're very good. They roll out the red carpet every time I want to do business with them. So I love them. And it's Allegiance Bank for those of you who are based out of Houston, Texas, or in the Texas area looking to place that. I think they're a great institution. I think their CEO is really smart and does a great job. I'm not sponsoring them. Just have a lot of debt.
Oh, anyway, hey, always give a good shout out. That's fine. That's
so I found somebody in the U.S. who was basically going to be my key principal. I didn't know what a key principal was at that time, but essentially, ideally, he would be my key principal and he would sponsor my loan if I brought him a good product. So I got to work, started looking for the deal, found this 24-unit deal. He said, "Okay, I'm going to be the key sponsor, but you know what? I get a pref." So he knew exactly how the process worked, I think, which is why I didn't have to invent it. He was like, "Okay, I want this much as a pref. I want this much on the back end, and you can charge, something a little bit on the front end as an acquisition, as putting the deal together." So he kind of babied me through that process, which I think was an education within itself, right? This is something that takes, if you are not in the business, this is going to take a lot of time for you to learn. And I think because of him babying me through that process, I was actually okay. By the end of it, not making any money. And the reason I didn't make any money, so let me just walk you through that deal, right? Let's tear it apart a little bit now. I paid $38 a door, which was I think 800 and change for the entire deal. We put about $300,000 in equity, which I put maybe $50,000 in equity in that deal. And cash flow, I learned very quickly. First of all, due diligence on neighborhoods, I learned very quickly is something that needs to be done because, you have to remember, I came from a country, the entire country is about 40 years old, 50 years old, right? So everything's brand new. We don't have pockets that were built in the 60s or 50s or 70s. It's like all of Dubai was built at the same time. And everything is, essentially A class, So I didn't really understand that metric. It was not something that I was looking for. I ended up probably buying a D class deal. So it wasn't a C in a B location. It was probably a C in a D location type product.
That's the worst. That's the worst kind of deal.
right. So the broker got me good on that one, right? And I think what ended up happening is that I learned a lot actually from owning that type of property in that type. I learned how to collect rent myself, right? By knocking on doors. I learned how to fix issues that are not issues that everybody's going to face in the real estate space, right? Theft was a common occurrence, and it's just something that I had to deal with. I learned a lot through that process. That education to me was almost like worth millions of dollars, right? Because as I scale, it's like I've been in the worst situation ever. It can only get better from here. And that's the reality of everything, like my KP was a great guy. we ended up selling that deal for 55 a door, which was like 1.2 something million. So we ended up making 100% cash on cash return. But most of that money went to my KP, the person who actually signed on the note. And that was the agreement that I signed in the very beginning. So if there's one thing I'm going to tell people, and I tell people all the time, it's that please, if you are looking to get started in commercial real estate, in anything that you can cost segregate, please don't look for the money on your first deal, because this is a very, very scalable business. And if you miss out on a little bit of opportunity, that opportunity could be your learning, could be your, there's so many things that come out of that that are worth far more than a couple of dollars in return on your first deal. Of course, ideally, you would want to make a return, you would want to make money, but just in case the deal pencils out to where in a couple of years you are not making money, move on to the next deal.
Yeah. Well, I know what, Hamza, I think that there's many, many gurus out there that will say, oh yeah, you get into your first deal and you're going to be a multimillionaire easily, no problem. And that's totally not the case. I mean, it sounds like your first deal, it was very painful. Hey, listen, I started off with my first deals. I started off in single family. I can assure you that I was not a multimillionaire because of my single family homes or my small multifamilies either that I started off with. It really, things didn't really start rolling once you start doing the bigger deals, but you kind of have to go through those little ones unless you partner up with someone. In your case, you got a good KP that really believed in you and they believed in your hustle. But it sounds to me though that it took a while to find that deal. I think that's probably where the persistence came in, right? Because it isn't like it just happened overnight. It took you a while to locate the asset. I mean, it probably wasn't the best asset in the world. It sounds like you just got by with the skin of your teeth, so to speak. Because I know that there's a big difference there between 38 a door versus 55 a door. But you did put in, you said $300K plus all the headaches. I'm sure if it's in a D area, you probably lost a lot of money in uncollected rent too.
Yeah. So cash flow, zero. Yeah. After I paid the KP, did all my work, put in all of nothing, zero, no cash flow.
Yeah. But it's an education. It's an education itself,
and
right?
That's how I really looked at it. I was like, okay, you know what? If I need to learn the American way, and if I need to learn this process, that's okay. I'm willing to pay the price. And for me, that was the price because I had my eye on the bigger picture, right? On the North Star, so to speak. I had my eye on the 1,000 units, 2,000 units, 5,000 units, And so for me, that 24 unit really didn't bother me at all.
Yeah. So what would you have done differently then? You mentioned the area, right? So that was a D-class area. How would you have underwritten it?
Okay, so I'll tell you how I would have not underwritten it.
Sorry. Good. Let's go there. Yes.
So do not trust your broker's package. And the broker's job is to sell you a deal. Now, I have a lot of friends who are brokers. Obviously, I'm in the business. So, of course, I have a lot of friends, who are brokers, and I love them dearly. And they're great friends of mine. And we probably have conversations, if not on a weekly basis, at least once every 2 weeks. I will reach out to them, or they will reach out to me, and we'll go get drinks or coffee or whatever it is. Of course, in COVID, we'll probably just stop at the phone call. But I maintain very strong relationships. However, that being said, a broker's job is to sell. And the multifamily space is a very hot asset class, extremely hot. And it sells mainly to the regular person on a pro forma basis, right? So all the numbers they have in there are numbers that they anticipate or they think that the property will bring. And I've seen a lot of deals where they've actually traded on the pro forma, not on the actual. So not on the actual numbers as to what it's bringing in today, but on what it could potentially bring, right?
And especially in Houston, right? In Houston, a lot of people buying on pro forma.
Yes, in Houston, a lot of people buying on pro forma. And the thing is that I understand it. This opportunity, like if I have a 300 unit multifamily community on an intersection that I will never get the opportunity to buy again, right? And I have to pay pro forma prices for it. I understand. I would, right? Just to get the opportunity to purchase that asset in that location, right? That location is so valuable to me that I'm okay with paying pro forma prices. However, that being said, since we are mainly in the value add space and we like to, put in our, our work into the value add component and bring that property up to standard and kind of make our money there, you have to look at the deal's actual numbers and not at your brokerage package. Because if you are in a competitive market or a hyper competitive market, everything's going to sell at a pro forma. Those deals you don't even want to look at,
Right.
and you want to go a little deeper. So lots of people getting into real estate are only going to see these pro forma deals because those are the deals that are easy to locate or easiest to locate. You need to put those on the side, keep working, keep hustling, and look for the deals that are trading at actual numbers. That is where the value is created. That is where you make, a substantial amount of income, like a 2x or a 3x return. You have to put the work in. Of course, it's not like, but what I'm trying to get to is you make your money when you buy, and that is what you want.
That's right. That's right. So lesson number one, never buy on pro forma, right? Always buy in actuals, always. So now what's the second lesson then? What would you say is the second thing to look out for?
Drive 3 miles out in every direction of the property. Just 3 miles. It's not a big deal. I drive 2 miles even out, just to make sure everything is where it's supposed to be. Because like that 24 unit deal that I bought was very close to the highway. There was a McDonald's about a mile away. There was a Taco Bell about a mile away. There was a gas station. It seemed like it was a great location when you enter from that one road, from that one highway. And it was awesome. It was really nice. Like to go to the property was really, really like, it was like a nice road. And then, on the other side, which I never drove, it was a really different type of environment, and so that got very difficult because those are going to be your tenants, right? That 5 mile radius, especially if you are operating in the C to B conversion garden style apartment community, right? Those are your tenants. Everybody, like your number one source of traffic will be either drive by or referrals, right? And those guys come from the surrounding neighborhood. So just make sure you have good people in place. So location is key. So just drive 3 miles out every direction. Make sure you're in in the environment that you want to be.
Yep. Yeah. Now, do you use any tools when you're underwriting an area? Like, are you using any sort of online tools or CoStar or anything else like that?
Yeah. So I use city data. What I've done is I've created a metric on geography and the markets that I'm interested in, and I have them all mapped out. And I would say 85% of my underwriting I do is from city-data.com. So for any of you that are interested in looking at new markets or looking at a market, city-data, I think, is literally your best friend. This is not for running comps. This is for just running zip codes, areas, school districts, crime rate, age, population, median income. There's a couple of verticals. And what happens is as you become more comfortable and you underwrite more deals, you will lose some of these verticals. Like you will realize that, okay, maybe median income is not what I need to be looking at. Let's push that aside for now. And then you may have that come back in for another deal of yours, right? There's a lot of verticals you can look at. I would say CoStar is great. I love CoStar. CoStar is really good in their reporting and maybe to pull comps and to see what else is out there and what's traded. But I use for my apartment stuff, at least, I use mainly city-data.com. I think they are the number one metric to go to just to make sure that the market that you're investing in, regardless of price per door, is a good market.
Yeah. No, city data is great. And I think the thing to watch out for many, I guess depends on the market, is the age of the data. Right. I mean, for the most part, in a typical Midwest town, for instance, data doesn't change all that much.
Mm-hmm.
But there's some areas that are just exploding now. But at the time that the data was loaded into city data, into their database, maybe the city was experiencing a downturn or something like that. So there's times when you could find opportunity where the data, city data, shows that things are moving slowly, but in reality, things are moving quickly in that area, and it's actually a hot market. So part of it is tempering, like, what's reality versus what's the data say, right? So, but at least it gives you a good indication as to what you're dealing with, for sure.
Yes.
Yeah.
It does give me I think it gives me a holistic picture on what is going on. Like if you were to pull up Austin, or North Carolina or Phoenix or parts in Florida, I think the data is fairly accurate in these major metros, and you can really catch a trend. Also, I use another metric, which is single family home data. So I pull up single family home data, and what I've learned is the multifamily space is about 17 months behind the single family space. So if there's a single family boom in a certain economy, in a certain market, that boom will 100%, without a doubt, be experienced in the multifamily space within the next 17 months. It could be earlier, it could be a little later, but within that 17-month period, I see there is a correlation between single family and multifamily as well.
Interesting. All right. So does it operate the same way in reverse? So if single family starts tapering off, does the same thing happen in multifamily?
I think that's a good question. Okay, so I think I know where you're trying to go with this, and I will tell you that yes and no. It could, if the government does not introduce stimulus or manipulate the economy.
Yeah.
However, because of the manipulation that we have going on right now, or the stimulus, right? I don't think the banks are ready to deal with what's going to come if there is a downturn, right? So we have so many artificial parameters at this point where the ups there's a correlation, the downs there could be a correlation, or if it was a natural situation, there should be a correlation, but I don't think there is, just because of the amount of stimulus that we're seeing pumped into the economy.
Yeah, absolutely. And I think, and that's the thing, is like, you really have to temper also what is going on with the economy, what is going on with comparable assets. I mean, clearly, when let's take that example again of that one deal you bought at $38,000 a door. If the homes in that area are going for $30,000 a door, you're probably paying too much per door on an apartment, generally speaking, right? Generally speaking,
right.
So that's another good indicator there. Now, what about a third thing, the asset itself? Like, did you underwrite the asset too? Did you actually get an inspector, look at the asset, have them inspect all the units, the breakers, all that stuff?
Yes. So no. So because that was my first deal, I get it. I should have. I didn't. I was honestly surprised that the bank lent me money to buy that deal. Because once you get into the larger deals and you start getting the large debt, like those are kind of requirements. You know what I mean? It's like the bank's gonna come, they're gonna send their inspector. Their inspector is gonna be like, you know what, that foundation doesn't look too good. Why don't you get it inspected again? And then we're gonna have to do that. And then there's gonna be a phase 1, a phase 2, roofs, electrical. Like, it's almost like your bank is your friend, your lender is your friend. And by bank, it could be Freddie Mac, it could be Fannie Mae, it could be CPS, it could be your just local bank around the corner. But your bank is your friend. Like, they want to make sure that you are buying into something that is reasonable, and they will often get into detailed inspections, whether it's a boundary survey and there's issues on one side of the property where it's not clear, and they're gonna go into that before you close, and all that is usually taken care of prior to closing, right? On my first deal, the bank didn't ask me anything. I think it was just because the loan amount was maybe not up to a certain limit to where they have to get into like all these approvals. It was like, yeah, sure, yeah, whatever, and they sent out somebody. I think it was somebody who did like a boundary survey, and that was the extent of the due diligence. Basically, it was like, okay, this land checks out, it makes sense, it is what they say it is, and so that's it, we're buying the deal. And so of course, if there's a few things that I've learned over time, it is that fixing things that are visible to the eye are easy and cheap. Fixing things that are not if you have one of those old pipes underground and you have a leak and you have to run one of those lines every week into one of your deals, you've got problems, man. And those problems are going to be big, expensive problems. And so those are the things that really we look at this point when we underwrite deals, right? We want to make sure that things they're not going to be 100%, because you have to realize that construction only got like relatively good in the 80s. Prior to the 80s, it was still like there's stuff out there that's little, not straight or not accurate, or, things weren't done the way they are today. So if you're buying a deal pre-80s, so even actually pre-70s, 70s, the late 70s, they had fixed a lot of their issues with the foundations and the piping and all of that. But if you're buying anything that was built in the 60s or earlier, you're look for things that are not visible to the naked eye, right? So bring people, run your lines, run cameras, with drones. Things are so easy now. Fly your drone, look at the roofs, make sure they're intact. If you feel like they're not, then that may require an inspection anyways by your lender. But if not, just fly drone. I mean, everybody these days has a drone, and it's so easy. And the camera quality on those things are just like so good to where you can zoom in and you can probably find rust on an AC compressor that was installed on the roof with very little effort. And that's just all part of your due diligence. It can be fun. Like, I love it when they call me in and they're like, hey, we want to inspect the roof because I have this little drone that I bought, and I get to fly it and take pictures and take it out. And, so it's just having fun. At the same time, it's a due diligence process.
Yeah. But definitely looking at the pipes underneath, hiring a plumber to run their cameras underneath and look for the busted pipes and all that. We actually just did that on a deal. And we found that it was these old ceramic pipes from a property built in the 60s. Yeah. It's all busted up. Well, not all busted up. There's a crack in it, and it will be an issue. If that thing collapses, it's going to cause a sinkhole right in the middle of your parking lot, right? That's how big this pipe is. So yeah, absolutely. Looking at things like that ahead of time and getting it handled before it turns into a big problem up front is a must. You got to do stuff like that. Absolutely. And it's cheap to do, comparatively speaking. Yes. $1,500, at least in this deal anyway, to inspect the line versus $10,000 to fix the problem.
Totally worth it.
Yeah, totally worth it.
And I mean, your investors are paying for it, right? It's part of your carry. And that's what people need to understand, that you're doing all this work, you're putting this deal together, you will get reimbursed for all of these things, right? I mean, it's just making sure that you're making a sound investment. The last thing you want to do is cheap out on a couple of inspections, right? And then find out later on that this is like, oh my God, this is like a $20,000 repair bill.
Yeah, that's right. And I guess probably the fourth thing to consider is the financial side and the other documentation. I know we talked about buying pro forma versus actual, right. But then you also, and then we know we didn't make any money off this thing, but then you also have all of the, if we dig into the contracts, dig into the some of the other issues with vendors and things like that you might have, like CoinMac. You guys have CoinMac out there, right?
Yes.
Yeah, they're the absolute worst company. For anybody listening, don't ever do business with them. This show is not sponsored by them. It's not the reason, though. But and that's a whole other show we can have about that whole discussion. But that's one example, though, too. CoinMac, for instance, the reason why I hate on CoinMac specifically is because they lock you in on these 10-year agreements where they're basically getting all the upside. And you're paying for the water, the electricity, the space. They collect all the money, and they usually get to keep it all. But because the way that they write their agreements, for the most part, for some owners anyway, they end up snookering them, and it's difficult, if not impossible, to get out of them. Yeah. So that's one thing that we look at when we're looking at a deal. We actually check that stuff out. We look into that.
Yes, absolutely. So CoinMac, the water heaters or boilers or chillers or any contracts that are include maintenance or warranties, that's all important stuff, because these are all expensive parts of the deal. You have to make sure that everything checks out before you get into a deal like that. We had a deal recently, I think it was like a 200 unit deal, and we had the chiller go out on it, and it was a $60,000 repair bill. But lucky for us, we had realized that when we bought the deal, that chiller was an old chiller, and it was on its final stretch. Like, we could tell that thing's gonna go. So we actually negotiated that $60,000 up front with the seller, and the seller said, you know what, you're right, this chiller is about 10 years old. It's gonna give up any minute, and I'm gonna give you the $60,000 credit for it. So there you go. That's good underwriting right there, right? You have to catch these things in advance.
That's right. Well, 10 years, is that usual life cycle for a chiller? I thought they go longer than that, no?
I think in Houston, Texas, just because of
Oh,
the heat, I think 10 years is a good run.
yeah, yeah, yeah,
Uh,
yeah, yeah, yeah.
you'd want to. I think. Okay, so I think the way they built them at that time, maybe it was 10 years. The way because the new unit we got looks completely different. It has a lot of technology in it. A lot of circuit break, a lot of like there's a computer that runs that entire thing. There's like a management system and a process, and so maybe the newer chillers have a different way that they run, and maybe that extends the life of the chiller. But the older ones, yeah, I think 10 years is a good run in Houston, Texas.
Hmm. Hmm. Interesting. Interesting. Now, what other aspects are you looking at from the contractual financial perspective when you're considering a deal?
Contractual, financial.
Like vendors, things like that.
I'll start with the debt that you place. So when we in the multifamily space, we love IRRs. IRRs are our best friend, and we want them to be in the high teens to the 20, low 20s, and that's kind of where the industry is sitting at right now. And I think a lot of people get caught up in the IRR and then base their entire underwriting and on that number, and they'll manipulate stuff in order to get to those numbers. I've actually seen other GPs who are friends of mine promise IRRs that are, I think, not reasonable, right? And all of that is done based on a little bit of manipulation, and we all do it, to a certain extent. If you're looking at a 13.7 IRR, what difference would it make if you took it up to a 14.2, right? Just to get into that 14 to kind of 22 number where the industry stands. Now, now the thing is that I think that underwriting deals can be easily manipulated. I think occupancy can be manipulated. I think collections can be manipulated. It's just how, I guess, how people choose to underwrite deals. The way I underwrite deals is completely different than the way other people underwrite deals, and uh, and I think from a contractual and financial standpoint, that is something that you have to take a look at. So your vendors have to be in place, ready to go with pricing on every detailed line item that you are requesting in order for that number to pan out where it's going to. Otherwise, what's going to end up happening is you're going to look at one aspect of your deal, which is the financials, and you're going to look at it and you're going to be like, okay, this is a great deal. It pencils out at 17% IRR over the next 5 years. And it's great. But if you don't have those contracts in place, if you don't have those vendors in place, and one or two items, line items, larger ones, are a little over what you had originally anticipated, guess what? Those numbers are going down. So
Mhm.
I think they kind of work hand in hand, to where it's not the chicken or the egg, which one came first. You have to do both of them together at the same time, right? So you have to work with your vendors, and at the same time input all that data in your financials, but also check your LTVs, so your loan to values. Make sure you're putting enough equity in that deal to where it makes sense. Also, that you are placing long term debt, unless it's a value add deal and you want some type of bridge debt to fix it, and then place long term debt on it. That's also a play that I see. But in my case, I like to put long term debt, and I like to raise rehab money from my investors as well, as opposed to get that on like some type of bridge loan leverage type deal. And the reason for that is it just gives me more freedom to do what I said I was going to do with the money. Because with the lenders, there's a draw process, and it can get very challenging at times, especially if it's a bridge loan, because they tend to sell those loans multiple times within a very short amount of time, and you're dealing with a different lender every couple of months. You know,
Yeah. Yeah.
so it's just easier to deal with it, and you can do what you said you were going to do quickly, effectively, and get out of the deal, or turn it around um, and recapture all that equity.
Yeah. 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 Well, I think one good way to look at a deal when you're first looking at it anyway is try to find a reason to kill it. Right. So as opposed to manipulating the numbers, as opposed to trying to finagle the income or the occupancy to make it work in your favor so you can just get a deal, you're trying to find a way to kill it. You're trying to find a way to not to make it work. And the deal has to prove itself to you.
Right.
Very, very different. Very different. And yeah, Hamza, you're absolutely right. There's guys that they're still, even today, promising a 20 plus IRR. And it's like, come on, man, it's not even feasible. There's no way.
Yeah,
I mean, and I mean, even if it is feasible, even if it is real, you never want to say that because nobody's going to believe it. It's too rich. It's too rich,
It's on the higher end of the scale. You always want to be on the lower end, just to be conservative. Under promise, over deliver. You'll always get more people that way interested in it.
That's right.
And that's just kind of how we look at it.
Yep. Yeah. No, man, it's one thing. I love underwriting deals too. So that's one of the things. And I think if you're going to have any type of success in this business, you have to really like underwriting deals because you're going to be doing a lot of that. You're probably looking at at least 100 deals before you find one that may work. And even that deal may end up failing. So it requires a high degree of persistence when you're looking at deals. And I imagine the same thing happens in your market. It's the same thing happens in mine. Very rarely does a deal just fall in your lap. I mean, that kind of stuff happens when you hit 1,000 units. Then yes, a broker will call you up and say, hey, I have a perfect deal for you. Yeah. But it takes a while to get there. It takes a long while to get there.
Absolutely. Yeah. I would say because the Houston market is so hyper competitive, that building relationships is far more important than having assets under management. I know companies that are far larger than myself, and yet I get access to deals first just because I built that relationship, and if anything, I think now for people who are interested to get started in real estate is the best time to build relationships, not to buy any deals, but call your brokers, call your bankers, tell them, hey man, I'm looking, I'm thinking, because business has slowed down a little bit, right? The brokers are sitting on deals. They're sitting on, and the brokers want to transact. They are performance driven. Now I think is the best time for people to start interacting with their brokers in their local area, just to build that network, to build that relationship. Call them up every week. Hey man, what's going on? Or hey, whatever, what's going on? And just build that relationship. Believe me, that assets under management has nothing to do with a deal being presented to you. If a broker has a strong relationship and feels that you are a closer, right, or you have a good chance of closing, you will get those deals even before the bigger fish.
That's right. That's right. You just got to make sure that you know your stuff. Definitely know your data, know what an IRR is, know what an NOI is, know how to spell NOI, of course. What is it? How does it work? All those key things about speaking the lingo of real estate is going to be absolutely key to getting an audience with an actual broker and everyone that supports the broker as well. And of course, the team, got to build the team, got to have your team in place. 100%. So Hamza, what is that one piece of bulletproof advice that you would give to someone listening right now?
So I'm going to give you advice that I would give myself if I was 10 years younger. So I'm 35 now. If I was 25, the one thing I would tell myself is don't stop looking for deals just because you don't have the money. And don't stop looking for money just because you don't have the deals. They are not related. They can be worked out individually. So always keep looking for money, right? And always keep looking for deals. Because what happens is people who can't raise the money are like, oh my God, I can't raise the money, so I'm not going to look for the deal. And people who can't find the deal stop raising the money. Oh my God, I don't have a deal, so I'm not going to raise the money, right? And it is a cycle that is never ending. And if I were to give it, and that was one of my biggest hurdles when I was in my 20s and when I moved here to the US, I was unable to raise money, so I stopped looking at deals. And that in itself was a barrier that I created for myself. So if I have any wisdom that I could pass down after being in this business for this much time, it's that do both of them together. It doesn't have to stop.
Excellent. Love it. All right, guys. Well, if you want to reach out to Hamza, you can reach him via his contact page on his website at grayspearcapital.com. I hope you got a really good insight on the underwriting process and how to maximize your deals. Thanks for tuning in, and I'll see you in the next episode.
Thank you for listening. We hope you enjoyed the Bulletproof Cashflow podcast.